Hi, everyone. In today's video, we're going to explore three critical financial statements that every business owner needs to master: the income statement, balance sheet, and cash flow statement. Together, these give you a full picture of your business's financial health. By the end of this video, you'll know how to break down these statements and use them to improve profitability, ensure liquidity, and sustain long-term growth. Let's dive in. Lesson 1. Breaking down the income statement. First up is the income statement, also called the profit and loss (P&L) statement. This is where you'll find key metrics like revenue, gross profit, and net income, which tell you how well your business is performing over a period. Revenue is the money your business earns from selling products or services. It's the top line on your income statement. Example, a retail store might bring in $100,000 in sales during the month, which is recorded as revenue. Next, we subtract the cost of goods sold, COGS. These are the direct costs of producing your goods, like materials and labor. Example, if that retail store spent $50,000 on inventory, that's the COGS. The result? Gross profit. This is what's left after covering your production costs. Example, if your revenue is $100,000 and your COGS is $50,000, your gross profit is $50,000. But we're not done yet. From gross profit, we subtract operating expenses like rent, utilities, and salaries to get to net income, the all-important bottom line. Example, after subtracting $20,000 in operating expenses, the store's net income would be $30,000. Gross profit tells you how efficiently you're producing your goods, and net income shows how much profit you're keeping after covering all your costs. Now that we've broken down the income statement, let's talk about analyzing it. The goal is to understand how profitable your business is and to identify any red flags. Profit margins are your go-to tool for measuring profitability. Start with your gross profit margin. Example, if your gross profit is $50,000 and your revenue is $100,000, your gross margin is 50%. Look at the trend over time. Is your margin shrinking? That could mean your costs are rising faster than your revenue, which is a red flag. Watch for other red flags too, like declining revenue, rising COGS, or consistently low net income. If your margins are below industry benchmarks, it might be time to raise prices, negotiate better deals with suppliers, or cut operating costs. Lesson 2. Decoding the balance sheet. Next, let's move on to the balance sheet. This statement shows a snapshot of your business's financial position at a specific moment in time. It's made up of three main components: assets, liabilities, and equity. Assets are what your business owns. These can be current assets, like cash and inventory, or non-current assets, like property or equipment. Example, a restaurant might have $20,000 in cash, $10,000 in inventory, and $100,000 worth of kitchen equipment. Liabilities are what your business owes. These can include short-term liabilities like accounts payable and wages, or long-term liabilities like loans. Example, the same restaurant owes $30,000 in supplier payments, accounts payable, and $50,000 on a loan for kitchen equipment. Finally, we have equity, which represents the owner's claim after all liabilities have been deducted from assets. Example, if the restaurant has $130,000 in assets and $80,000 in liabilities, the equity is $50,000. The balance sheet follows the formula. Assets equals liabilities plus equity. Now that you know what's on the balance sheet, let's look at some key ratios to assess your business's health. Current ratio measures your ability to cover short-term obligations with short-term assets. Current ratio equals current assets divided by current liabilities. Example, if a business has $60,000 in current assets and $30,000 in current liabilities, the current ratio is 2.0, meaning they have $2 in assets for every $1 of liabilities. Quick ratio is similar but excludes inventory, offering a more conservative look at liquidity. Quick ratio equals current assets minus inventory divided by current liabilities. Example, a company with $50,000 in cash, $10,000 in inventory, and $25,000 in liabilities has a quick ratio of 2.0. Debt-to-equity ratio shows how much of your business is financed through debt versus equity. Debt-to-equity ratio equals total liabilities divided by total equity. Example, if a construction company has $400,000 in liabilities and $800,000 in equity, their debt-to-equity ratio is 0.5, meaning they're using 50 cents in debt for every $1 in equity. These ratios give a clear picture of your liquidity, financial leverage, and overall health. Lesson 3, the cash flow statement. Last but not least is the cash flow statement. This shows the actual cash moving in and out of your business during a specific period. It's divided into 3 sections: operating, investing, and financing activities. Operating activities cover cash flows from your day-to-day operations, sales, payments to suppliers, and wages. Example, a coffee shop receives $50,000 from sales and pays $25,000 for inventory and wages, leaving $25,000 in positive operating cash flow. Investing activities reflect long-term investments in assets like property or equipment. Example, a landscaping company spends $10,000 on new equipment, which is an outflow under investing activities. Financing activities include transactions like taking out loans, issuing stock, or repaying debts. Example, a tech startup raises $200,000 in capital from investors, recorded as an inflow under financing activities. By reviewing these sections, you'll know where your cash is coming from and where it's going. Now that you understand the cash flow statement, let's talk about keeping your business liquid and sustainable. One way to ensure liquidity is through cash flow forecasting. This means predicting when cash inflows and outflows will happen, so you're not caught off guard by shortages. Example, a consulting firm forecasts that a large contract will pay out in 60 days, so they cut back on discretionary spending until then. You also want to build a cash reserve to cover unexpected shortfalls. Aim to set aside 3 to 6 months' worth of operating expenses in a savings account. Example, a bakery sets aside a portion of its profits each month, ensuring they can weather slower sales during the off-season. Finally, improve cash flow by speeding up customer payments and delaying expenses where possible. Offering early payment discounts or negotiating longer payment terms with suppliers can make a big difference. Example, a freelance designer offers a 5% discount for clients who pay within 10 days and negotiates a 60-day payment period with their own suppliers. By actively managing your cash flow, you'll have the liquidity to handle challenges and the sustainability to grow. To recap, the income statement, balance sheet, and cash flow statement each give you different insights into your business's financial health. The income statement shows profitability, the balance sheet reveals financial strength, and the cash flow statement tells you whether your business can sustain itself day to day. Together, these tools are essential for making smart, informed decisions. Thanks for watching, and be sure to review your financial statements regularly to stay ahead of the game.